Hello, everyone. I trust that you had a wonderful week thus far, right? I believe that most of you have been doing the right thing, right? Which would be, just following the rules, only trade whenever we have high impact news events and so on. So as you guys can see, right, today we had news at 2 p.m. So it was FOMC meeting minutes, which is, different from the actual volatile FOMC, right? The real, liquidity insertion that we will have will be tomorrow, right? It will be Thursday during the New York session, right? And then we will have, a continuation of that on Friday during New York session, right? So, of course, you guys must know by now that Q3, right? It doesn't matter which cycle you're looking at. Q3 usually inputs the most liquidity in the marketplace. And if not, then it will be Q4, right? So if you were to, rate each quarter, which, is more volatile, then it would be Q4 would give the most volatility. It's just that whenever it does, it's usually not as frequent. So yeah, it's just not as frequent as Q3, right? So Q3, usually gives a lot of volatility or a lot of opportunities, and it doesn't matter if you're looking at the daily cycle, if it doesn't matter if you're looking at the weekly cycle, the monthly cycle, right? It just does not matter. Even looking at the quadrennial cycle, right? It's the same thing, right? And this is why we have the presidential elections during Q4, right? Because it's a news event that will give a lot of volatility or inject a lot of engineer liquidity into the marketplace, but it's just not just doesn't happen as frequently as the liquidity insertion that we have in Q3. And then of course after Q3, right, in the ranking of volatility or quote unquote liquidity, you have Q2, and you already know that Q1 usually does nothing, right? So right there alone, right, that's a lot for you to take in, right? Again, let's say it again. First you have Q4, then Q3, then Q2, then Q1, right? So in terms of liquidity, it's like reverse: Q4, Q3, Q2, Q1. In terms of, which quarter will give you the most movement. And of course, this is fractal, right? And as we know, time is fractal. And price moves according to time. Nice. So that was, very good to begin this session with. So yes, as we expected or wanted to see, right, this week so far, right, and this is a weekly candle, as you guys can see, right, price has been, just moving up, right, for the US dollar index, right, just, following in the direction of the cracking correlation that we highlighted here the last time we went live, right? And of course here you can see right here we have this failure swing, right? And this week you can see that we just, dropped for the euro and also the Great British Pound. So, of course, right, we're expecting, right, price to just follow in the direction of this cracking correlation, which means higher prices for the US dollar index, lower prices for the euro, and lower prices for the Great British Pound, right? At the moment, right, there is a cracking correlation between the sync of price in, between the FX market and the index futures market, right? So if you look at index futures, you see that price is doing a completely different thing, or, in a completely different way, meaning that price is, consolidating and just dropping for the euro and the pound, while you have the S&P 500, NASDAQ, and the Dow going higher as we expected, right? So here, right, we could see price reach for this low and ultimately this fair value gap looking at the Great British Pound, taking note that this is a weekly time frame, right? And we can expect manipulation above the true open of this week, in terms of the FX market. And then we could see price continue lower, right? Or, right, that does not completely have to happen, right? We could see manipulation in the opposite direction, then sequential SMT, then we could have a short-term rally. But we're leaning more to the downside since, right, we have the higher time frame credit correlation, which is the sequential SMT. So here you can see that we had price, right, trade into this fair value gap right here. This is the daily time frame, right? So right here, right, this is a model in itself, right? And remember that we expected the dollar index to just continue higher. This week, we expected the euro to fall, and the same for the British pound, right? So here you can see that price trade into this fair value gap, but this candle right here, right, which was Tuesday's candle, and remember, we don't trade Monday or Tuesday this week. So this is a way for you to gauge your daily bias, right? And just by me saying that, you know that, it's important and you should take note, right? So this is the daily time frame. All of these candles, right, represent, data which presented itself for, a 24-hour period, right? So this candle was Monday. Here, this was Tuesday, and here, this was Wednesday. So Wednesday's candle expanded as we expected due to the fact that we had a news event, right? That's why it did so. But prior to Wednesday, Tuesday's candle right here, what was it? It was a precision swing point. So this candle right here, this is a up-close candle for the US dollar index. This is a up-close candle for the euro, right? On a regular day, right, a normal day, you would expect this to be a down-close candle if this is an up-close candle, right? So due to the fact that we have this cracking correlation here, price has already lodged itself within this fair value gap right here. And if you look across, you'll see that we also have another gap right here, right? So this is a balanced price range. Right? So, it's easy to expect that this would happen. And remember, we already talked about expecting higher prices, right? Which means that as long as we saw a cracking correlation, we should expect prices to go higher for the US dollar index and price to go lower for the euro, price to go, lower for the British pound. Whenever you see price like this, right, and as long as you see the precision swing point form on the daily time frame, such as here, and we'll just use the euro for this example, right? As long as you see this happen, right, and this, this is, more powerful if the day that the precision swing point forms is a day that has no news events, right? So this day, right, it's going to depict or give the information in which this day should use. So this is a daily time frame. We'll drop to the 4-hour time frame. The 1-hour time frame. And here we are. So here, this is the daily fair value gap. This, from this range here to this range high here, this range to this range low here, this was the daily precision swing point, right? This was it. Here, you can see that we had a credit correlation, right, between the British pound and the euro, right? So on the 15-minute time frame, you'll see the SMT right here, but I could just put it there for you guys to see, right? Where we had the British pound trading above this high right here, right? And the euro just failing to do so. And also we had the US dollar index failing to do so as well, right? And also you should also always remember that these candles right here, right? These precision candles are very important, right? So here you can see that we have a up close candle here, up close candle for the euro, and also up close candle for the US dollar index. Before price turns around, you'll always see something like that, right? Always, it will always be there. So here, right, as long as price pulls back within this range, and you can see that price is not clear here at all, it's just chop, right? But as long as price pulls back within the range, you could be trading in the direction of this precision swing point, right? And the direction was that we expected price to go lower. Also, this candle right here, right, which this was the high, which we used to depict the higher time frame fair value gap, but since we're looking at the 1 hour time frame right now, it just looks like a old high, right? So price ran about this old high, and this created what? It created a quote unquote breaker, but this is the actual breaker. So this is the real one, right? This is the one that works. And here, right, at the opening of this breaker, what is it? It is the true weak open. And as you guys remember, this is what creates a high probability breaker. Because right here we had price fall, then trade above, true weak open, then it fell. Once it broke below this low, then it became high probability. Price trades back within it, consolidates around the midpoint, then we continue lower. Here you can see that price, did 80% of what we expected it to do. So yes, we talked about these highs right here, that we expected price to be drawn to these highs. So expected price to be drawn to this high, and this high as well, right? But the thing that we did not get was for price to run below these lows. And, this is something that happens. It does not happen a lot, right? But it does happen. And that's totally fine, right? Whenever you see things like this happen, then you put your attention to the new weak open gaps that overlap with fair value gaps. So if they don't overlap with fair value gaps, then you just shouldn't be paying attention to them if there is no cracking correlation. And also here you can see that this is a difficult feat to accomplish, right? So we expected the euro to go lower, and at the same time, what do we expect for the S&P 500 and the Nasdaq, the Dow? We expected those to go higher, and they usually move in tandem, right? So we expected them to break away, and there was a lot of content that was pieced together, in a ready format for you to, understand without me, talking for 1 hour in the last session that we had. So here, price broke higher, price broke high, and price broke higher as we expected, but we just did not get, these lows to be ran out, right? And whenever you see something like this, right? So yes, we did have SMT, right, between these wicks right here, right, and on the higher time frame of the forward time frame, these were wicks, right? We did have SMT between these wicks, but this would not have been high probability for me, right? So I was waiting, for price to just break below this low. Once we had sequence SFT, then we would expect this to happen, which did happen already, but yes, it's okay. And here, looking at the 4-hour time frame, you can see where we had right here, we have this high probability entry, right? So here on this specific candle here, and this candle is important. So here we have, multiple cutting correlations, but I will just talk about this one, right? So price trades within this gap, right? And it overlaps with new week opening gaps. Even if it was just one new week opening gap, right, that would be enough, right? Here still doesn't really matter if it's one or two, right? Once you see this happen, right, price fall into a fair value gap, and they have new week opening gaps, expect higher prices, right? Especially when you see price leave equal highs like this, right? Especially when you see things like this happen. So obviously, looking at price right now, where do you expect price to go? It's obviously going for our main drawn liquidity that we already established, in the past stream. This high for the, and let's do this again. I made a mistake right here. So yes, it already took the high for the S&P 500. We're expecting it to go above this high right here, and we could see price continue above this high as well, right? And again, right, once you see price fall within a fair value gap, so here, this candle, specific candle right here, is within a fair value gap. Here, this candle was not within a fair value gap, right? That is a tracking correlation again, right? We had price consolidating right here. Price fell back within the consolidation while price was expanding right here. Also, you can see that, we had price within the S&P 500 here broke above this high. Price in the NASDAQ broke above this high. But while price was here at this specific point, right, what happened? The Dow, so yeah, the S&P 500 did not break above this high as yet, but the NASDAQ did. Correct myself. The Dow, it did not. It wasn't even close to this high. It wasn't even within the 50% of Monday's range, right? So that is a tracking correlation, and serves as a mean of expanding or expecting expansion. Due to the fact that we had expansion here, we had consolidation here, then you will, see the Dow expand aggressively. And here, right, we expected price to do exactly what's here, right? We didn't expect price to just completely blow through this high. We just expected it to fall, and before going higher, at least take this low out, right? And towards Bitcoin. So I hope you found this useful. Again, we will be back. Hopefully, I will try to see if we can be here Saturday, right? If not, then it will be, and it's easy to know. This is for like those of you that don't know the schedule already, right? If you want to know when I'll stream next week, then you just look at the news for next week. If there's no news on Monday, then we will go live on Monday at 6 p.m. Eastern Standard Time. So that's the time that we will be going live next week, right? And then, of course, following we have Wednesday, right? And just by looking at this, we know when the high below the week is going to form for next week already, just this week. So yes, I hope you found this useful. Good luck and good trading.